So back in 2025, the unstoppable force of London's billionaire property buyers just simply vanished.
Yeah, vanished is exactly the right word for it.
I mean, a 7.8 billion pound luxury market crashed by like 65% in just a matter of months. So today, we are taking a deep dive into the Carter-Jonas Spring 2026 update via Property Industry Eye to figure out for you exactly why the super rich abruptly stopped buying real estate last year.
And you know why they are suddenly rushing back with their checkbooks wide open in 2026?
Right, because that drop wasn't just some minor correction.
Oh no, not at all. Total investment basically evaporated. It shrank from 7.8 billion pounds in 2024 to just 2.2 billion last year.
Wow.
Yeah, and if you look at properties over 5 million pounds, those sales crashed from around 750 down to just over 200.
Just over 200. That is staggering. And it wasn't just isolated to London, right?
No, regional England saw a massive 55% drop for homes over 1.5 million.
Okay, let's unpack this, because it felt less like a natural economic slowdown and more like, I don't know, a high-stakes game of musical chairs. Like the wealthiest buyers and sellers suddenly just refused to move until they knew what the taxman was doing.
What's fascinating here is that buyers and sellers were essentially paralyzed by anticipation. They were looking right at the November 2025 autumn budget.
Right, they were terrified of potential changes to the capital gains tax.
Exactly.
But wait, let me stop you right there. Capital gains tax is paid by the seller on their profits. So why would a tax on sellers paralyze people who are trying to buy?
Well, it creates a massive bottleneck on both ends. First, terrified sellers just pulled their properties off the market, which completely evaporated the available inventory.
Right, you can't buy what isn't for sale.
Exactly. And second, ultra-wealthy buyers, they treat these homes as liquid assets. So they were running the math on their own future exit costs.
Wow, I see.
Yeah, nobody wanted to commit millions to an asset without knowing, how heavily their eventual profits would be penalized when it was their turn to sell.
So the entire market basically froze in terror over this impending budget. But what actually happened when the chancellor finally opened the briefcase?
The uncertainty vanished. I mean, the actual budget was far less disruptive than the doomsday scenarios people had, like priced into their heads.
But the frozen capital started flowing again.
Yeah, according to Samuel Richardson at Carter-Jonas, 2026 opened with returning momentum. We are seeing buyer sentiment bounce back, aided by easing mortgage rates and rising wage growth.
Here's where it gets really interesting, though. Is it genuine optimism? I look at this and I wonder if wealthy international buyers are just swooping in because London property values softened by like 3 to 6% during that freeze.
Right, they see a deal.
Exactly. Are they truly confident in the UK, or are they just grabbing a temporary discount?
Well, it's really a mix of both. You are right that a 6% drop acts like a luxury discount tag. That relative value is absolutely what is getting international money to the table right now. But international buyers wouldn't park billions in London just to save a few percent up front if they didn't fundamentally believe the market's long-term stability would hold.
So they are capitalizing on a momentary dip.
Yes, but relying on London's enduring global appeal.
They might be relying on that appeal, but they definitely aren't ignoring the regulatory hurdles coming down the pike. Because even with this early 2026 thaw, there is another speed bump they are already factoring in.
You mean the new high-value council tax surcharge?
Exactly.
Right, so this targets properties over £2 million, and it's going to bring an estimated annual cost of roughly £2,500 to £7,500.
But wait, that surcharge doesn't even take effect until April 2028. Why is a tax that is 2 years away impacting buying decisions today?
If we connect this to the bigger picture, it's because the Valuation Office Agency is beginning its assessments right now in 2026. For buyers at this tier, an impending 2028 surcharge isn't really a future problem.
It's a current mathematical calculation.
Precisely. They project those future carrying costs out over the next decade, and they just subtract that exact amount directly from their 2026 offer price.
Wow. The hyper-wealthy literally price the future into today's bids.
They really do. It proves how much this tier of real estate is driven by anticipation. They froze in 2025 preparing for a budget, and now they are calibrating their bids in 2026 preparing for a 2028 surcharge.
So what does this all mean for you? The UK luxury market took a massive hit, survived its 2025 tax panic, and is now projecting a steadier 2026.
Yeah, buyers are locking in those softer prices and stabilized interest rates.
Which leaves you with this to think about. If the mere threat of a tax change can wipe out billions of pounds in luxury transactions in a single year, only to bounce back months later, how much of a luxury home's value is actually based on the bricks, the mortar, and the location, and how much of it is purely psychological tax speculation?